So, put a post on Instagram last week, got a lot of attention that interest rates, home mortgage rates, were approaching 8%. In some instances, they're already 8% or over 8%, depending on your credit score, different parts of the country, different things of that nature. So, interest rates are rising at very high levels. It's affecting people, especially if you're trying to buy a home, or if you're trying to borrow money, and you see that interest rates, you're trying to buy a car. So interest rates are rising, right? So why are interest rates so high? And when do you think we'll see relief from these very high interest rates?
Yeah, it's a great question. We probably won't see any relief for about 18 months. The reason why, government debt is out of control. We've talked about that endlessly here. Global markets across the world are losing faith in our political system. There are too many bonds available and no one wants to buy them. And if we're going to be honest, the bond market and those who manage the bond markets are not as smart as we thought. And of course, because they want to correct this market to have a soft landing, which we won't have. Those are the 5 reasons why interest rates are continuing to be high. They want to suppress the consumer to not have as much power so that they can drive them back into the workplace and get everyone from off this whole work from home vibe. It is not working at scale. But when you factor all those things in together, we'll talk about the war that's going on later. But when you factor all those things in together, that's why interest rates have been going up. And they won't be coming down anytime soon. And also the biggest reason, quantitative easing has ended for the foreseeable future. So now rates have to go back up. As I said before, we are just operating in the interest rate environment that we should be in. But when our debt, I talked about it last week, but we are now paying more for the interest of our debt than we are national defense. That is a problem.
Yeah, you talk about quantitative easing. For those who are not familiar with that, I just want you to break that down for a little bit, because I guess the timing of what we're seeing now is important, right? So if you bought a home in the 80s and you heard 7.75 interest rate, you're thinking that's pretty good, right?
Yeah.
Based on, with the times that we were in the 80s. But hearing it now and looking at it from a 20-year time span, you realize, wait, there was a 10 to 15-year period of we were having interest rates of 2%, 0 to 2%. Yeah. And so could you just break that down for people who are not in the know?
Quantitative easing is just the government pouring in money to offset the losses that were not being produced by the economy. So when we had the crash, or the dot-com crash that led into 9/11, that led into the 07 crash, when Obama got in, one of the first things that he did was say, hey, we need to put more money into the economy so that the United States does not collapse. It's great, but it's like robbing Peter to pay Paul. Like if I give you money at 0% interest, everyone's going to thrive. But when that is taken away, think of it like if your parent gives you $100,000 as a teenager. Kudos to my mom and dad for never doing that, because I would have blown it and acted stupid, right? But the government was our financial parent for 12 years and gave free money. Interest rates were low. Everyone was partying and having a good time. But now we have to be financial adults and things are a lot tighter. So that's essentially what quantitative easing is.
Yeah. And there's some pain, right? Like we talked about it last week. In order to reduce inflation, there's going to have to be some pain. And raising interest rates, the amount of money it's going to cost you to borrow has to increase. So they want people to slow down. So these are some of the things that we're talking about. Yeah, it sounds terrible, but these are the necessary causes, quote unquote, in order to reduce that inflation number.
And quantitative easing and interest rates, I talked about this on Stock Club call last week. They are 2 of the most important indicators that you have to focus on when investing. RSI doesn't matter as much. Shout out to everyone who uses RSI. I'm not alienating anybody. I've learned that lesson, right? But when you're looking at real economic indicators that matter, quantitative easing is 1. Where interest rates are is number 2. Yield curve will be number 3. So you have to factor those in to see where we are, to know if the market generally is going to go up and go down. When we have quantitative easing where interest rates are 0 to 2%, every stock is going to do well. MyPillow.com is going to probably get an IPO and SPAC Central. But when interest rates are higher, 4 to 9%, only the good companies are going to rise to the top.
Yeah. And it's a laggard metric, right? So if they raise it to 7.75 now, we won't know the effects of it because it happens on a month-to-month basis. We'll have to see. That's why the timing is important, right? When we talk about 12 to 18 months down the line, it's because we'll be able to see the effects of raising it in this fourth quarter, the first month, right? And so we'll have to see by maybe summer or maybe the fourth quarter of next year to see the long-term effects of it. So that's important to know, right? The interest rates get raised now. Yeah, it affects you now, but we have to see the long-term over a time period.
I agree.
Yes, sir.